What's up, you guys? Uncle P in the house, and today we have the first update video of my $100,000 stock portfolio that I'm building. I've done one episode so far, but essentially what I'm doing is documenting the process of building up a $100,000 dividend-driven portfolio in a commission-free brokerage called M1 Finance. I'm really excited to share with you a few brand new investments. I also might have made a little mistake, but I'll let you guys be the judge of that. Then we'll also go over the other stocks in my portfolio and evaluate their performance so far. I will mention that this is for entertainment purposes only. And of course, when you guys are doing your own investing of any kind, please do your own research. I enjoy allowing my experience to be viewed so we can thrive together and be better investors. If you guys are new to the channel, and I'm sure you are, I like to talk about stocks, investing, and that green stuff we all love, money. And to my subscribers, thanks for your support. Now let's dive into the portfolio. As you can see here, it has a current value of $1,754.70. Now, before we go any further, I do have to do a quick explanation here about why these numbers may seem a bit off. So you see here, we're valued at just over $1,700 and the portfolio's down $41.65. Now, at first when I saw this, I was definitely a little confused, and also some of my returns down here didn't quite make sense, and that's when I looked into this and realized that what we are seeing here is something called a money-weighted return. It's kind of a confusing topic, so I'll do my best. Now, the calculation you're all familiar with is time-weighted return, just like in the S&P 500. Now, the main difference between how time-weighted and money-weighted returns are calculated is how they consider the amount and timing of cash flows. And when I say cash flows, I'm referring to any money that enters or leaves your account. This includes deposits, any withdrawals, fees, transfers. Let's say that you were to put a large sum of money into this account right now. The portfolio's performance would carry more weight towards that in the calculation as opposed to your existing stocks. This money-weighted return will be useful to us as time goes on to evaluate my investment strategy. But for the time being, I'll be using the time-weighted return, which you can find in the Holdings tab, and we'll get back into that in just a little bit, okay? Now, before we review my portfolio, I want to go over my two newest investments. Both of these stocks do pay a dividend, but one of them is going to make me huge capital gains in the future. And that stock is Apple. That's right, good old Apple stock. We will go over the numbers, but I want to give you a little snippet of my bull thesis on Apple so you could better understand why I've added this stock to my portfolio. So hear me out. Apple's ambitions in the electric vehicle space are totally ramping up, and in recent reports, they have suggested that the iPhone maker has held talks with Hyundai and Nissan on a partnership to develop an Apple car. I think they will have a formal partnership with an auto manufacturer sometime in 2021, which could lead to a bull case scenario in which shares of Apple would soar. Now, pressure for Apple to finalize its plans is likely rising as recent announcements from Ford and General Motors revealed their EV ambitions as well. And with Biden pushing to go green, I believe now is the time for Apple to dive into the EV space. The electric vehicle sector is entering somewhat, you could say, like a golden age, as, you know, certain factors like battery technology and different regulatory incentives, tax credits, and more affordable models, they create this perfect storm, so to speak. Also with a market that could be $5 trillion plus over the next decade. And if Apple gets, even if they got 5-10% of the share, that would be another major growth aspect within its business. Now, Apple could get a strategic partnership with Hyundai, Tesla, Ford, NIO, or Volkswagen. Your guess is as good as mine right now, but nonetheless, they will land with someone. The top two choices, in my opinion, are Hyundai and Volkswagen, because Hyundai has huge production capabilities because of its electric global modular platform, and its robotic assembly design could fit well with Apple software and autonomous capabilities. Now, Volkswagen's modular electric drive matrix is the next-gen framework that would allow easy integration of new models. Volkswagen is also invested in QuantumScape, which could develop a differentiated pack for electric vehicles with its solid-state battery technology. Basically, Apple with the right partner would be a major force in the EV industry and could disrupt the market from the likes of Tesla, GM, and Ford, if the company is able to get the Apple car on the road sooner than later. Apple is currently trading at $121.26, has a market cap of $2 trillion, a price-to-earnings ratio of 31.8, and yields only 0.67% annually. As we look at their 5-year, you'll notice this company has some pretty steady growth, as well as growing their dividend. Apple has paid and grown their dividend for 8 consecutive years at a 10% growth rate over the last 5 years. Their annual payout is 82 cents per share, and they distribute their dividends in the months of February, May, August, and November. They also have a very low payout ratio of 22%, which is expected to decrease by 3% over the next year. Apple comes in with a dividend safety score of 99, which is very safe, and makes them a top stock pick in my $100,000 stock portfolio build. I'm now going to get into the other stock I added, which is Allstate, ticker ALL. And just before we hit the numbers, here's a few reasons why I believe in Allstate as a long-term dividend play. So, some investors rely on dividends for growing their wealth, and if that's you, you might want to know that Allstate is about to go ex-dividend on March 3rd, and that means on or after March 3rd, investors will not receive the dividend, which will be paid on the 1st of April. Allstate's next dividend payment will be 81 cents per share. Last year, in total, the company distributed $2.16 to shareholders. And last year's total dividend payments show that Allstate has a trailing yield of 3% on the current share price of $106.06. Now, if you buy a business for its dividend, you should have an idea of whether that dividend is reliable and sustainable. So let's investigate whether Allstate can sustain and afford its dividend and see if the dividend could grow. Now, dividends are usually paid out of companies' profits, right? So if a company pays out more than it earns, then its dividend is usually at greater risk of being cut. Allstate is paying out just 12% of its profit, which is super low and leaves plenty of breathing room and is exactly what I'm looking for. Generally speaking, the lower a company's payout ratios, the more resilient its dividend usually is. Now, have their earnings and dividends been growing? Let's just say businesses with strong growth prospects usually make the best dividend payers, because it's easier to grow dividends when earnings per share are improving. If a business enters a downturn and the dividend is cut, the company could see its value fall tremendously. That's why it's comforting for me to see Allstate's earnings have been skyrocketing, up 28% for the past 5 years. Now, the main way most investors will assess a company's dividend prospects is by checking the historical rate of their dividend growth. 10 years ago, Allstate has raised its dividend by approximately 15% a year on average. Also, both per share earnings and dividends have both been growing rapidly in recent times, which is great to see. From a dividend standpoint, should investors buy Allstate? Typically, companies that are growing rapidly and paying out a low fraction of earnings are keeping the profits for reinvestment in the business. This strategy can add significant value to shareholders over the long term, as long as it's done without issuing too many new shares. I think this is a pretty attractive combination. While Allstate looks good from a dividend perspective, it's always a good idea to be up to date with the risks involved in any stock, and understanding them should be part of your investment process. Allstate is currently trading at $106.60, has a market cap of $32 billion with a low price to earnings ratio of 8.5, meaning that the stock could be undervalued, and I believe it is. Also has a nice dividend yield of 3.04%. Now, Allstate has grown their dividend for the past 10 years with an uninterrupted streak of 11 years, no reduction. Their annual payout is $3.24, and pay their dividends quarterly in the months of January, April, July, and October. Allstate comes in with a dividend safety score of 80. So there you have my 2 new investments. And now getting to the stock I sold. I honestly jumped into it just too quick, focused on the short term. Luckily, my portfolio is new, and this is just a part of the process in building one. I ended up selling my shares of Pfizer. And after further review, I decided this company is just not worth the investment for me, even though they are considered undervalued right now and is a dividend payer. Who knows, maybe my mind will change in the future, but for now, I want to be able to close my eyes every week as I contribute to my portfolio and have no qualms about it. I have a long-term investing strategy for all stocks I own, and if that's an investment strategy that you follow, I hope you sleep good at night too. Lastly, we're going to check out all the stocks in my portfolio and see how they have been performing. So I have funded this account with $1,800 so far, and the first stock we're going to look at is Microsoft. I currently own 1.2 shares with a value of $286.75, and I'm down 1.75%. Next we have is Innovative Industrial Properties. I own 1.2 shares with a total value of $244.02, and I'm down 5.79%. Then we have Apple at 1.8 shares with a total value of $220.55, and we're down about almost 3%. Next is Realty Income at 3.3 shares with a value of $200.89, and we're down about 2%. And on to Matthews International. I own 4.9 shares with a value of $176.81, and we're up almost 4.5%. Then we have 3M. I own 1 share of 3M with a total value of $175.15, and we're up about 0.5%. Then we have Atmos Energy with 1.6 shares at a current value of $139.14, and we're down 4.8%. And we have McDonald's at 0.6 shares with a current value of $129.75, and we're down 3%. Next is Allstate at 1.1 shares with a total value of $122.33, down about 1.5%. And lastly, we have Canoe with 4.6 shares, current value of $59.31, and we're down almost 15%. Now overall, my cost basis is $1,799.80 with a value of $1,754.10. And back to the time-weighted return here at 2.51% with a loss of $54.10. Now my overall yield for this portfolio is 2.34%, and all of my stocks fall under safe or better safety scores except for IIPR, which is borderline safe right now. I have an average annual income of $41 in dividends, and I have received dividends from Matthews International so far for 49 cents, and I also received a dividend payment of 26 cents from Realty Income, which I receive monthly. I'm not as well diversified as I'd like. I do want to add, I'd say maybe 3 to 4 more stocks. And to close out the portfolio for this update, the last stat I'll give you is currently I have a dividend growth rate of 7.4% over the last 5 years. So that's where I'm at with building my $100,000 dividend-driven stock portfolio. Do you guys like my investments? Should I not have sold Pfizer? I'd love to hear your thoughts down below in the comments section. And while you're down there, feel free to donkey kick that like button as it helps out my channel in a big way. If you enjoy my content, please consider subscribing. As always, thank you for watching, stay safe, stock up, and I'll see you in the next video. Peace.